Stick my tongue to that stupid pole, that's dumb.
That's cause you know it'll stick.
You're full of it. Oh, yeah?
Yeah, like double dog dare ya.
All right. Get up, Edwards. Come on, Karen.
This is nuts. Thug?
I double dog dare you. Words that are usually tauntingly said amongst youth as they defiantly challenge one another to a certain thing, today are being said to Jerome Powell. Find out how and more on today's episode of Financial Strategies with Andrew and Daniel Agemy. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about double dog daring, right? And I think most guys, I don't know if girls did it quite as much. Most guys remember playing in the playground, 6-year-old, 8-year-old, double dog daring people to do something, jump off the swing, eat something like dirt. I don't know, right?
Or a live fish, right?
Or live fish, some bugs. Yep. So double dog dare, what's that have to do with finance? Well, when we look at the mantra for the last few years, right? The mantra has been don't fight the Fed, don't fight the Fed, don't fight the Fed, right? And that's worked pretty good with quantitative easing, especially the last 5-6 years. And it seems like things will just keep going up forever, right? And
well, that's what our memories say, right? Because we have short memories, but yeah.
We've got Jerome Powell over there saying, Fed chair saying, I'm going to bring pain. I'm going to bring pain, right? Markets are too exuberant. Inflation is going crazy. It's come down, but I'm not sure it's going to stay down. And they've been wrong so many times. He's dug his heels in to say, we're not going to be wrong this time, right? We're not going to be wrong. We're going to correct over then under because we don't want to be embarrassed again, right? With the whole inflation's transitory thing, all this kinds of stuff. They're not going to do that again. They're going to overcorrect. And that's what he's saying, right? He's saying these words. We're going to make sure we're done with this inflation. So if we have to overcorrect, we will. And he's saying we're going to bring pain, right? What do they say that the Fed's chair, the Fed's job is to pull the punch bowl away at the party, right? When people had too much punch, there's that too much punch given out at the party. And so he's saying, I'm going to pull this bowl away. And investors and markets, you can look at them and they're saying, nah, I double dog dare you.
Yeah, well, I just got this headline off the internet that says only the Fed can stop 1999 rally, tech like 1999 like tech rally. Somebody from Wells Fargo says, and that's what you're saying. Everybody thinks everything's good, and they say, well, only the Fed can do it. They're not necessarily saying double dog dare you, right? But still, others are looking at it like, it's that's not going to happen. You can't do it because interest rates go down and people are going to be flooding the market, and they think the market's going to go up, but that doesn't always happen. And we have, people have a short memory. We know that every year, every 4 years, when election time comes and we vote for a new president, and people forget from previous times. And, same thing happens when it comes to investing. We tend to think back only a few years. And, but if we look back longer than that, 15 or plus years, we're going to see something that today looks very much like what was going on at that point in time, or even maybe even a little bit before, a few years before that. So it's crazy when we look at that. And but people don't want the Fed doing what the Fed does. And some things the Fed does are good, and some things the Fed does is they shouldn't be having their hand in.
Yeah, well, I think what people are having a hard time believing, markets are having a hard time believing Jerome Powell, right? He's been wishy-washy. We could think back in 2018, that Christmas Eve massacre where he tried raising rates before, and it got too rough, and he capitulated and started cutting rates. Um, Markets took off, and they've really gained a lot of ground since then.
Mm-hmm.
And when we look back in history, this is normal. This is usual, right?
Mm-hmm.
This is usual. People don't want anything to do with stocks at certain points of times, and people think risk is my friend. They say things like this: "Risk is my friend," right? Even if they're not actually saying those words, they're not
Right.
verbally spitting that out. It's in their head. Risk is my friend, and you hear it in phrases
That's how
like,
they act. Yeah.
"Well, I didn't do a good enough job saving for retirement, then I think we need to take on some more risk," right? You hear things like stock market only goes up over time, right? Things like this. Um, Stocks will come back. They always come back. And definitions are important, right?
Right.
Time frames are important. If we look back, you're talking about learning from history. If we look back 150 years, markets have averaged 9%. Now,
Mm-hmm.
did they do 9% any of those years? Maybe one or two, but that's
Yeah.
an average. That only
Right.
works in an Excel spreadsheet. People's lives are not in Excel spreadsheets, right?
That's for sure. Right.
And when your longevity is in the past, when you're not 20 years old, when you're not 40
Yep.
years old, when you're not actively
Time's behind you.
saving, you
Yep.
start taking and you start drawing from your assets.
Mm-hmm.
This is where time is not your friend,
Right.
because you want to pay your bills, you want to go on vacation, you want to do the things you want to do tomorrow and the next
Yeah.
day and next year and the next 15 years, no matter what markets tell you you can do. You want to enjoy retirement and not have to wait 10 years for markets to come back before you can start spending.
Yeah, Daniel, when you're talking that way, it's reminding me of one of the papers that we have. I think we should give this paper out. It's called Hard Lessons of the Stock Market, right? And people are enamored with the stock market, especially baby boomers, but this is something that will give you, it's about 3 pages. And if you're in our listening audience, we'd love to send this to you for free by calling 800-725-7616, called Hard Lessons of the Stock Market. And you can learn from history, and those that don't learn from history that, are doomed to repeat history. So we'd love to have you learn from this so that you can take advantage of the pain that others have experienced in this. So please call 800-725-7616 for your free copy of Hard Lessons in the Stock Market. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Double Dog Dare Ya. Daniel, that's great synopsis of what's going on and the people. The stock market history repeats itself because there's only one thing throughout time that hasn't changed. 3 things in life are certain: death, taxes, and change. But one thing doesn't change, and that's humans, people, emotions. And that's why history repeats itself, because about the one time one generation forgets the mistakes of another generation, they make the same mistakes. And so history repeats itself. And that's what we're talking about here is people are saying that Jerome Powell, oh, whatever you do, the market's going to end up going up over time. But people forget how the market comes down and stays down for a period of time before it goes up.
There is a hedge fund manager that said, you're in a recession, when there's capitulation, because people have to incinerate capital, right? Like markets, money is incinerated, right? And it's been a long time since that's happened. And are we wishing for that? Absolutely not. Okay. But what we've seen and what we feel bad for is our industry, right?
Yep.
Their incentives are different than a retiree's incentives.
Right.
If you pulled your client's money out of the market in 2006
Mm-hmm.
or in 1995,
Mm-hmm.
right? You got
Okay.
fired.
Yeah.
You got fired. Why? Because for 2 more years, the markets went up and went up big.
Right.
Now, pretend you didn't get fired and
Okay.
then markets crashed.
Mm-hmm.
You have all your dry powder. You didn't lose $1.
Mm-hmm.
And you get to decide, you as the advisor, client working together, if you want to redeploy. Now, nobody wanted to redeploy because they thought it was capitulation. It was true capitulation where people thought markets would never go up, stocks would never go up again.
Right.
And this is cycles that continue to happen. You can read newspaper clippings, you can read articles from these times, and they sound exactly like what's happening today. We
Right.
could read stuff from 1997, 1998, where there's only a few companies dragging up the whole market. Doesn't that sound like what they're calling the Magnificent Seven now, right? There's 7 stocks that are dragging up the entire market, right?
Yep. Right.
It's eerily similar. Even if we go back to like 1927,
Right.
1928,
Right.
what's being said sounds exactly the same. Now I get it, and I would fault no one for saying, well, look at what I've seen for the last 12, 13 years. Things have just gone up, and for the past 5, I think markets have averaged something like 15%. Every time you got out, you got punished, right?
Mm-hmm.
Why would
Mm-hmm.
someone want to get out? Why would someone want to get out, AAA? They
Well, to
only
protect
go
the
up
money, right?
like that's your
Well,
experience
that's
for the last 5 years,
but that's not the
15%
case.
return.
Yeah. That's the whole point. That's the whole point. And that's it. And it's those people that say, why would people want to get out, that are saying double dog dare you to Mr. Powell, right? And so you're listening to Financial Strategies with Andrew and Daniel Agemy. And we got time for us to take a break. We're talking about what's being said to Jerome Powell on double dog dare you, and what's the deal with that, and how that's going to affect you, and how you can learn from that. We have a book today that we'd love to be able to give you, that be able to help you. Financial Insanity: How to Keep Wall Street's Cancer from Spreading to Your Portfolio. This is the concept that we're looking at in regard to, the whole idea of Wall Street is keep your money in forever. The market always goes up, and that's not true, especially if you're 50s, 60, 70, 80, especially the long haul is behind you, not in front of you. So this book will be able to help you. Easy read book. If you're a slow reader, you can read it in 3 hours through and through. Financial Insanity, yours for free by calling 800-725-7616 for the next 5 callers. 800-725-7616 for the next 5 callers. Call now.
This is Financial Strategy with Andrew and Daniel Agemy.
AAA, some people may be like, why are you guys talking about the Fed? How this doesn't reflect regular people. What do we care, right? And why it affects people is an analogy I heard recently is talking about the economy as an elevator. And you've got Jerome Powell up there, the head of the head of the Fed, right? Fed chair. And his job is to try to slow down the elevator. The elevator is moving up too fast. That's inflation, right?
Okay.
It's going up, faster, faster, faster. It's getting out of control. And he has one tool to slow down the elevator. He's got a whole pile of anvils. Okay. And anvils are interest rate hikes. So think about the anvils, different weights for different, 25 basis points, 55 basis points, skip. He's not going to drop one, right?
Okay.
So he's standing up there with these big anvils, and he's dropping them all in the elevator to slow the elevator down. Now, he doesn't know when they hit the elevator because he's looking at backwards information, right? He's looking at data
Time
that's already
lapse kind
passed.
of
So
thing.
he's seeing
Yeah.
what the elevator did, 3, 4, 5 a year ago, months, year ago,
Or
right?
floors ago, right? In the case
Or
of
floors
elevator,
ago.
right? Right.
There you go.
Yeah.
Right. And
Mhm.
he's not seeing what it's doing now. So he doesn't know if these anvils have hit the elevator yet and
Yeah.
slowed the elevator down. But he keeps dropping them, dropping them, dropping them. So this last hike, he finally decided, or this last Fed meeting, he finally decided we're going to pause. I'm not going to drop an anvil this time. We're going to pause and see how they affect, how the economy has been affected by all these anvils we've dropped on it. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's episode is called Double Dog Dare Ya. And it's what's being said to Jerome Powell as he is trying to take care of things, his job with the Fed, and it affects you and me in our economy. And just to let you know, the economy and the stock market are two different things. They're not the same thing. And a recession and the stock market are not necessarily the same thing. They can be congruent. They can be at the same time or not. So you need to be able to look at that. Business cycles and the stock market cycle, they're different. They're different. They might be interrelated, but different. So please understand that. But today's topic, double dog dare ya. And we're glad to have you with us as we delve into this today and what that means to your portfolio. Daniel, when we're talking about this and interest rates hikes and, that's hurting the stock market, right? Because that's what kind of made the stock, that's not what made the stock market down. That's what's holding it back. And because when interest rates go up, it's like, why should I risk my money? If I can make 5.5% on a treasury, which is the most solid, safe thing that there is, why risk my money for maybe a 9% average over 150 years with the risk? Or if you say the last 20 years, right? The last 20, 22 years or whatever, this decade, this century, the average is somewhere in the 7% range, give or take. So why would you increase your risk by double your risk over a treasury, quadruple your risk over a treasury for 1.5% more? This is crazy, but this is what people are doing.
Well, that's part of the daring, right? That's part of the daring is that people are saying risk is my friend, but people are also saying the Fed is my friend, right? The Fed has my back. The Fed has the market's back.
Right.
And so it's easy to project, right? It's what humans do is they take recent experience and they weight that heavier than historical experience, even if it's your own historical experience, right?
Right.
So people are saying the Fed is my friend, the Fed has my back because it has,
In the
right? With
past. Right.
quantitative eating, with the plunge protection team, right? Where when markets go to a certain level, when they come down a certain level, all of a sudden, all these, options, these futures, these options are bought on the market. And the markets keep coming up. We add some new program that adds liquidity, and people can start buying up the S&P or start buying markets. And this has gone on for really the last 12 years. It's been a huge driver in markets. And so this is what people's brains, this was past experiences are telling people that the Fed has my back. If we get a 20% correction, the Fed is going to step in. The Fed is my friend. And Powell is saying, no, that's not what's happening. And people say, hey, you've changed your mind. You've flipped flop back and forth so many times. We'll dare you. And that's why NASDAQ is going up, 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 even though people are talking about like, oh, there's a recession going on, right? We hear this. You go to a party, you hear there's a recession going on. This person lost their job. Hey, It's tough out there. People are really struggling. But you look at markets and they're just going up, 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 up. You listen to Powell and he says there's going to be pain. We're going to have a recession. We're not going to support markets, right?
Mm-hmm.
And people just keep saying, "Hey, I dare you.
Right.
I
Okay.
dare you. You're gonna flinch before we do."
Yeah, there's a lot of lessons that you can learn by the stock market, watching the stock market and understanding the stock market. A lot of people don't understand or don't, they just go along with the crowd. Well, if you're listening to us today, we'd love to give you a paper where you don't have to go along with the crowd. You can learn, you can educate yourself so that you can do make decisions on purpose rather than by going along with the crowd or just, by default. It's a 3-page paper called Hard Lessons of the Stock Market. We'd love to put that in your hand. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Double Dog Dare Ya. If you want your free copy of Hard Lessons of the Stock Market, call us at 800-725-7616 for your free, no obligation copy. 800-725-7616. Double Dog Dare You, Daniel.
So as Paul is dropping these anvils onto the elevator, right?
Right.
And they're not sure how they're going to affect it. The elevator is the economy, and we don't know if one's hit. We don't know if 7 is hit. We know some have hit because that's what happened with all these bank failures, right? So we know some have hit because all these banks had these failures because of the interest rate hike. We don't know what else is going to blow up or have problems because of these hikes. People are talking about landing, right? They're comparing the Fed rate hikes to landing a plane. And it used to be we're going to have a hard landing, and then it was a soft landing. And now people are like, there's not going to be any landing. It's just so perfect. There's not even going to be landing. We'll just keep going. And these things are ridiculous, but this is what like investors are being trained to think. And we're not talking about trying to time markets necessarily, but we're talking about building a strategy, right? We're talking about building a strategy. And if you're close to retirement, if you're nearing, if you can taste retirement or you're in retirement and you've benefited from this quantitative easing, you've benefited from we could have a whole show on all the things, all the coincidences, all the blessings, all of the economic miracles that have gone into or pulled from the future to add value to drive up, especially US markets, right?
Right.
And if you've benefited that and you're close to retirement, you need to start thinking about protecting what you have more so than, well, maybe we'll get another year, maybe we'll get another 2 years of just exuberance, just like in we look at the 2 most recent times, exuberance, 1995, 1996, 1997, right? And then 1998, things just, it was like just you want to try to time that last year, and you want to bet your retirement on that. That's up to you. Our job isn't to beat you over the head with a stick. Our job is to explain to investors what's going on and let them make educated decisions. Don't make a decision by mistake, right? We're private CEOs or CFOs, right? We work for people who are the CEO of their retirement portfolio, and people who want institutional advice, people who want to run their retirement like an institution, they want a CFO in there explaining what's going on so they can make decisions. Instead of hearing what, the talking heads on TV are saying when they're looking at backwards indicators too, or they're doing what sells, right?
Right.
They'll get fired if they tell you what's really going on because that doesn't sell, right? I've heard so many times recently of people talking about they couldn't do what was in the best interest of their client because they'd get fired. And it hurts me so much because that's the way that the financial world typically works.
Right. And the egregious thing about that is that, I don't know who you're speaking of, but I know that people who call themselves fiduciaries are even in that same, predicament. And that's so just because somebody calls himself fiduciary doesn't mean that they're going to be able to do what's right. It's a difficult thing. And if you're just tuned in, you're listening to Financial Strategies, Andrew and Daniel Agemy. We're talking about double dog dare you. Because people are saying, to Jerome Powell that, we dare you that you're going to, hurt the economy or keep the markets from going up. But our whole point that we're trying to bring across is helping people to understand a different way of doing things. You can always make money, invest money, and do it. The question is where and how, and that's what we have. We're interested in tried and true methodology of always earning money. We're not, proponents totally 100% of, hoping in the stock market. We believe that there's a place for the stock market, but you have to have the right balances. So today we are going to take a break in a few moments, but before we do, we'd love to give you this book that will help you and educate you so you can make a decision on purpose, by a friend David Scranton, Financial Insanity: How to Keep Wall Street's cancer from spreading to your portfolio. It's a little bit older book, but it's an easy read book, and it still has a lot of good principles that will benefit you and help you to take more of a defensive stance as you look at your retirement. Either prepare for retirement or live in retirement. You can have this next 5 callers at 800-725-7616, 800-725-7616 for the book Financial Insanity. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
So Jim and Sue came in recently, and we were talking about and looking at, they came in for a free financial physical, a second opinion, an MRI on their finances. We looking at one of the things I asked them was, hey, so Jim and Sue, what percentage of your money do you think should be in the stock market right now? At risk in the stock market, where it can go up, it can go down, all that kind of stuff. And they said, oh, Andrew, we're here because we're getting ready to retire. And, we can't afford to lose any of our money. So, we got to say 90% safe, 10% at risk in the market. That's all we want at risk, 10%. And then I look at their portfolio, and I went through it and recognized that in actuality, 90% of their money was at risk in the stock market and 10% was safe. This is something that happens over and over and over again. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about double dog dare you, Mr. Powell. And that's what markets are saying to Jerome Powell, Fed chair, who's telling people, we don't have your back anymore. We don't have the markets back anymore. And AAA, there's probably folks listening and they're saying, hey, I agree with everything that you guys are saying. I think stuff's getting a little bit long-winded. It's been a long time since we've had a real recession. And these things are important. It's creative destruction. There's a lot of companies that don't do anything, right?
Right.
And you need a recession to get rid of those companies. They're using up capital, they're using up people's time, they're using up energy, and they're not of any value. And they need to go away. And that's what recessions do. But we've prolonged this bull run for so long. People are starting to think we've conquered the cycle and there will never be a recession again. Actually, I think Janet Yellen said that right before no, it wasn't Janet. Okay. But this is what happens over and over again. And so those people are listening, but they're probably in the same situation that your story referred to, because we see it so much. And they say, I told my advisor that I want to be moderate. I don't want a 40% drawdown, because that's historically a real recession. Stocks go down 40%, and people puke and they don't want anything to do with stocks for a long time. and people forgotten that, and again, we're not rooting for this, but this is what
It's what
happens.
happens. It's life. It's facts. Right.
And people who are listening are saying, I'm already protected because I told my advisor I wanted to be moderate and I don't want a 40% drawdown.
Right. Right. But that's not usually the case. And the reason why they think they're safe, but they're really not, in the case of Jim and Sue here, what happened was they said exactly that. But we told our advisor that we should be conservative, not aggressive. And he told us that he's got us conservative. But unfortunately, his definition of conservative was different than their definition of conservative. His definition was the conservative end of aggressive, where their definition of conservative was a whole nother thing, meaning that they don't want to lose money. They want to make as much as they can, but don't want to lose money. His was a whole different scenario on that front. And if you're positioned for that, and this recession happens, and Jerome Powell has an effect upon the market, or the markets just have an effect upon themselves, because like you said, there are some junk companies out there that have to go away at some point. And who will be left holding the bag? It's like a game of musical chairs going on right now, both with the market as a whole, as well as individual positions in the market, these companies and things. And when the music stops, who will be left without a chair? Well, certainly, our clients will still have chairs, but I don't know who in our listening audience, if you're going to have a chair or not, but that's going to be dependent upon you, upon what decisions that you make and the education that you have for yourself.
And people can do a second opinion. People can do a stress test of their portfolio, because it's better to do it now, waste this rally, than it is. Everybody's going to do it. When stocks correct 40%, everybody's going to do it. And everybody's going to be calling us, and we're not going to have time to help everybody. And that's that. So we're just trying to help people get ahead of the curve right now, because you've already gone through this, AAA. You've already gone through this with people twice, right?
Mm-hmm. Right.
And everyone's calling you, everyone's knocking on your door. Stop the bleeding, stop the bleeding, stop the bleeding. And you can only help who you can help at that point, because most people at that point, there's not a lot you can do.
Mm-hmm. Now's the time to do it. Now's the time to do it. The market has come down from January of 2022, came down a lot. It's up only 15%. It's not all the way back, to where it was from that standpoint, but still it's a good time because the market is high, and rebalancing. It's a great time to do some rebalancing. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is double dog dare ya. And that's what's being said to Mr. Powell. And we have a paper that we'd love to put in your hand to help educate you. It's about a 3-page paper, why investing in mutual funds could jeopardize your retirement plans. I know most people invest in mutual funds because it's easy, Daniel. And easy is not necessarily the best, right? There were a lot of things while you were growing up that I made you do, or you did yourself the hard way, so that it was beneficial to you later on. Even now, you exercise, you do a lot of things, you put a lot of stress on your body so that you can have things can be easier when it's time to do some exercising or mountain biking or whatever. And that's what this paper is about, is help people to understand how they can do things in a way that will benefit them, and how what you're doing now may not be in your best interest. Love to put this in your hand. Ask for the paper on mutual funds. 800-725-7616. 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Agemy. Daniel, risk is a big thing, right? And that's what we started off this segment with, talking about risk, and how people think they have less risk than what they really do. And there's all kinds of risks in this world and in investing. There's interest rate risk, there's stock market risk, there's all kinds of things. And one of my concerns is, interest rates are up right now, CDs are up right now, but that's right now. That's not necessarily the long term. And I know that there's a lot of people that are investing in CDs or interest-bearing accounts. And, and for now, or maybe the next 5 years, whatnot, they'll be in good shape. But then the question is, well, what's going to happen after that? And ideally, people's retirements they're gonna most people that hit retirement these days, there's a great chance for them, at least one of them, if they're married or what not, getting to age 90 years old. So their portfolios need to be able to last as long as they do. And the stock market goes up over time, but people don't think about the risk of withdrawing from their accounts because they have to with required minimum distributions, or because they want to because they need money to live on in retirement. There's some huge risks that people are facing that they don't even know. It's like they have their heads in the sand.
Yeah. Yeah. Let's talk about risk for a second. That's good, because there's a reason why the markets have done 9% over 150 years. And we can lay that out very, very easily for people to see and understand what's called equity risk premium.
Mm-hmm.
So when we look at investments and we look at the safest investment, that's typically considered the US 10-year treasury bond. You put that money in, it's backed by the strongest entity, government, organization ever. Well, at least in the 200, 300
Currently,
years, right?
Yeah.
Maybe some of those ancient times had civilization that was stronger, but in any of our lifetimes, it's the strongest.
Right.
And typically that yields right around 4%. So risk-free is considered 4%. Now, it has not yielded 4% for years, but that's beside the point. Okay.
Mm-hmm.
So that's starting point. So to get risk-free return, it's considered 4%.
Okay.
Now, if you want to take on a little bit of risk, you would go into a corporate bond. So now you're taking on corporate risk, and you get paid about a 2% spread typically for that.
Okay.
So now you're up to 6%, right? So you can buy a US Treasury bond, earn 6%, 10 years, get your money back, $100,000. You collected your $4,000 a year, right?
Okay.
So you say, I need to earn a little bit more. So you go into corporations, and they have the same thing. You buy their bonds, and they say to you, we'll give you a 10-year bond. We'll give you your money back in 10 years, and you can collect $6,000 in the meantime, right? It doesn't matter if the bond goes up above 100,000. It doesn't matter if the bond comes down below 100,000. In 10 years, you get your money back.
Nice.
And then stocks. So we're going risk-free, moderate, and now we're talking about equity risk, aggressive. And so they say, well, this is the most risky. This could go to zero, right?
Mm-hmm.
If a company gets into trouble, stock could go to zero, stock goes the company goes bankrupt. You're an equity holder. It doesn't matter if it's a junk rated company, if it's a good rated company goes bankrupt, you get zero if you're an equity holder, right?
Mm-hmm. Right.
So we'll tackle on another investors. When I say investors markets, they say, so you should get about another 3% on top of that, for what's called an equity risk premium. And that's where the 9% comes from.
Mm-hmm.
So it's not difficult to understand where that comes from. And it's not difficult to understand that. The question is, when we're this long into a cycle, is if that 3%, and if markets have averaged 9% over 150 years, and for the last few years, it's been closer to 15, we're going to get back to that mean. Is that 3% above what you could get from a corporate bond? Is that still worth it to you? Right. And there's a lot of advisors, when we go back to your story, people saying you're okay, that haven't gone through this, right? Because they haven't lived through a real cycle yet. Because a lot of the ones in the last one got fired, or the company they work for went the way of the buffalo.
Mm-hmm.
And so there's a lot of people who don't understand this. But then advisors have the same patterns and have the same biases because they've just seen stuff go up for so long and they think this won't happen again. But when you look at it like in this simple term, it makes a lot more sense, right? It's a lot easier to understand why you get 9%. And then when you see when we're above that 9%, maybe that extra 3% is not really worth what you think.
Risk. Right. That's the big thing. Is the risk worth it? In that example, is that 3% worth the risk, where you're multiplying your risk tremendously for that extra 3% in that example? And that's and like you said, things have been 15%, but in order to get that 9%, they've got to come down a lot for a period of time to average that 9%. And history repeats itself. So the likelihood that it's going to go over that 9% is not very likely. Well, if you're just picked up joining us, you're listening to Financial Strategies. Andrew and Daniel Agemy. Today's topic is double dog dare ya. And we're going to have to take a break. But before we go, we'd love to have you call and receive this book, Financial Insanity, by our friend David Scranton. It's got a lot of good tips in there, a lot of good information so that you can educate yourself and how you can do things other than what you've been used to for the past 20, 30, 40 years of investing in the stock market. It's still a place for that, but there's key in interest and dividends can make a huge difference in your portfolio. This will tell you more about it. Call 800-725, next 5 callers at 800-725-7616 will get you a free copy. 800-725-7616. We'll be right back after this.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
Daniel, Jimmy and Sue that we talked about earlier, once they found out that they had 90% of their money at risk and only 10% of it safe, were just so taken back by that whole thought. I mean, Sue almost began to cry and Jimmy was speechless. When they finally were able to eke out the words, well, what are we supposed to do, Andrew? We got more at risk than what we want. I don't know what else to do. Well, at that point, I said, Jimmy and Sue, here are your options. We can put your money through a financial MRI. We can show you what your different options are. And then once we went through that whole process, they were able to decide that they took their money that was not getting them their $2 million was not making them any dividends or interest, any kind of income that they could keep. They decided to switch to where they were getting $100,000 a year of dividends and interest. And the beautiful thing about that is that now, these 8 years later, they're getting over $150,000 a year of dividends and interest. Sue and Jimmy went from almost tears and not knowing what to say, what to do, to today they're elated and they're one of our best and happiest clients. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about double dog dare ya, and AAA. That's pretty good, because what's the purpose of your money? Did
have income?
Did people save their money so that they can try to watch it every day in retirement, try to get the $2 million to $3 million in retirement? Or did they save that money so that they could just have the lifestyle that they wanted to have and not have to worry about if there's a recession going on, if there's a pandemic going on, if there's anything happening, right? We save retirement money for a purpose, whether we think it or not. And the purpose is so that we can have the lifestyle we want without having to work in the future. And that's what you always say is the ideal retirement, is having too much money, right? Too much income, though, not necessarily portfolio size, so that you can do everything you want and have money left over.
Right. Yeah, it's not that people need $1 million, $2 million, $3 million, $5 million to retire on, because they're not going to go spend that money. They need an income to come off of that money to replace the paycheck that they're not getting anymore. And some people, they have pensions and they have Social Security, so they don't need that money to work for them. They think But, they really do, because at some point they're going to have required minimum distributions. And if they're doing withdrawal rather than taking dividends and interest, they can cannibalize their money. Many boomers think that they aren't drawing from their assets, but in fact they are drawing from their assets. They don't even realize it. Sometimes, I can't tell you how many people come in and say, "Oh, our old financial advisor is making more than we did this year." Andrew, and it's egregious. That shouldn't be the case. I love the new clients that come in and say, "Andrew, I don't mind you making money, but I just want to make more than you do." I said, "No problem. I'll make sure of that." But that's the idea. People need to be able to have an income when they retire and be able to weather the storms of recessions or depressions or whatever the case may be. Now, the only true security there is God's security. But there's a lot of things that can be done to protect you, but it's not following the Wall Street model. Wall Street makes money when the market goes up, when the market goes down, when the market goes sideways. Market goes three directions, stock market. But when do you make money if you're only invested in the stock market? Only when it goes up. And you hope that it goes up. But, hope is not a retirement plan. And so that's where, you can be assured of getting money from dividends and interest, guarantees, promises, things that will be able to help you last the long run. I want to tell you that you're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is double dog dare you. And we have a paper we'd love to be able to be put in your hands that will be able to help you be able to prepare for retirement. It's called Why Investing in Mutual Funds Could Jeopardize Your Retirement. And we'd love to educate you on this. Please call 800-725-7616 for your free copy of Why Investing in Mutual Funds Could Jeopardize Your Retirement Plans. Daniel, there are
hold on. You said that. Whoa, slow it down. You said that, and let's repeat that, okay? In your story, you said they brought in $2 million.
Right.
That they weren't sure what they were earning, if they were earning, market volatility, everything like this. And they went from no income or minimal income to getting paid $100,000 a year. And then 7 years later, not $100,000, $150,000. So that means in 7 years, $150,000 coming into their portfolio. So that means they could either spend an extra $50,000 a year, 50% more. Who doesn't want a 50% raise? I mean, seriously, a 50% raise, or they have $150,000 a year coming into their portfolio that they could do whatever they want. Mm-hmm. They could buy when there's good deals. They can give it away. They can take advantage of, just like the whole reason people think markets do so much more than 9% is because they're dollar cost averaging. They're saving their money and they're buying low when there's a 50% correction. Now, some people are upset because we haven't had a 50% correction. They haven't been able to participate in that. That's the drawback to markets only going up, is people buy higher instead of getting to buy lower. And that's how the markets average so well, is because those troughs have allowed people to participate. But if you're fully invested or you're retired and you need to take money out instead of save, that doesn't benefit you. That hurts you. That allows people, they cannibalize their money. But if you have $150,000 coming in your portfolio and you choose to reinvest that when stuff comes down, you can get some good deals too. But it's up to you, right? And isn't that what makes it so freeing? Is that you have $150,000 coming in each year that you can do whatever you want with?
It's a beautiful thing.
Yeah, I just thought we had to address that a little more because you went over it like it was no big deal.
No, I agree, and that's exactly what I was gonna, and how do you do that, right? People, I'm sure people in our listening audience are saying, how does that happen? How do you make that work? Well, there's a variety of investments, 6, 7, 8, 9 different types of investments that we then micromanage that money to be able to work for our clients. there's things in there that go up when the stock market goes up, but not down when the stock market goes down. That over the past year, right now, people have made 10 to 15% on those things. And once they make it, you make it. You don't lose it again. So why put your money at risk if you can still make money? And then there's other things that create, 4, 5, 6, 7, sometimes even 8% dividends and interest, right, Daniel? That we use to compound and reinvest to compound money. Whereas when people are investing in the stock market, all you're doing is growing your money, generally speaking. Where you're going from $10 a share, $11 a share, $12 a share. But the problem with that is it can go the other direction. And if you don't take it out, you lose it. Whereas if you're compounding your money and your $105,000 goes to 110,500, and then it goes to $117,000 because you're taking that 5% every year and compounding it upon each other. That's a beautiful thing. And that's what can change your life. It can change your stress levels. Daniel, one of the things I love so much is our clients that I see their eyes, I see their face, their stress levels just go down over time when they come on and they recognize and they get the idea how they can have income, all the income they need to last the rest of their life and more. Their looks on their faces are just so satisfying to see how happy they are.
Yeah. And that's the whole point. That's the whole point of the show. That's the whole point of what our business exists for. And that is to think outside the box, right? To create an income so that you don't have that stress. If they say that the definition of a recession is your neighbor lost their job. And the definition of a depression is you lost your job, right? And people have so much stress in recessions and depressions because what are they worried about? Their income, right?
Right.
When things are going good and you're not worried about your job and you're earning money, people are spending money, people are enjoying themselves. There's not a lot of stress, especially if you have a job that pays you a good wage, right? It's a whole nother story if you're not earning enough. But if you have, you're not worried. But when you see your neighbors losing their jobs, that puts panic and fear in you because you say, what if I lose my job?
Right.
And if it's a depression, you lost your job or, you've lost your job, then you're really worried because you're worried around running out of money. And when we talk about the strategies behind a successful retirement, we're talking about getting the portfolio set up where you don't have to worry about the recession or depression. And when I say it like that, I'm saying it where you're not worried about losing your job or your income, right? Losing your income so you can support that lifestyle, or actually losing it, because we've seen both in people who brought their portfolios in for second opinions. But that's the whole thing about the strategies in retirement income. The retirement income that we've been talking about throughout the show is that risk premium. If you're earning that 6% over the risk-free rate, that's pretty good because you can depend upon that, right?
Right.
And it brings so much freedom, like you're talking, that brightness in the eyes.
Right.
Because now you're not saying, oh boy, what would happen if I didn't have any income? I couldn't draw down from my portfolio, because that money's coming into your account. It's coming into your bank account. It's coming into your portfolio. You can do whatever you want with it.
Nice.
You can help somebody around you. You can go on vacation. You can donate to charities. You can help your grandkids go to college, or you could take your family on a vacation.
Yeah. Right. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been double dog dare ya. And, we're just trying to the reason Financial Strategies exists is because we believe that an educated retiree is a happy and stress-free retiree. And we're trying to educate you on what is happening with some of our clients and what's available to you in various ways. So don't settle for anything less and educate yourself. Today we have a book that we'd love to give you so that you can educate yourself, Financial Insanity, How to Keep Wall Street's Cancer from entering your portfolio. We'd love to put this in your hands. To the next 5 callers at 800-725-7616, 800-725-7616. And we look forward to educating you and helping you. And remember, an educated retiree is a happy and stress-free retiree.